Okay, so now we are live on YouTube and it's 11 a.m. So we will just start in 1 minute. Let's everybody join. And first of all, I will mute everybody so that we do not get intervened while talking. Then I will allow you, Mr. Vijaya Kittu, to unmute yourself so that it does not create any. Okay. You are also co-host, so we are good to go now. So first of all, let's welcome everybody. Welcome to Smart Investment and Smart Education Learning Forum. So as we all know, every Sunday we gather over here to get something new regarding to technical analysis or many fundamental topics also. This time we have gathered over here to address a new fundamental topic, which is long-term investment. Nowadays, intraday trading is quite in a trend, but everybody knows that if you want to grow your portfolio and maintain it, you must go for long term. So many use different type of strategies, that 2:1, 3:1. So that's how everybody works in long term also. If I personally say about myself, I also believe in long term mode than intraday trading. So it was just my point of view. Before starting about our writer's introduction, we will just share a small video of our product. So is my screen visible?
Yes, it is visible.
Okay.
Boss, best of smart services. Smart Investment proudly presents Boss, best of smart services. Boss is designed to beat best of the best. Our writers' top picks will be provided in Boss. On average, 2 to 3 stocks recommendation will be given in a quarter from each writer contributing in Boss. Recommendations will be a mix of different segments of stock market such as technical, fundamental, futures and options, technofunda, astrofunda, commodities and others. Advices will be either for intraday, short-term, mid-term or long-term positional. Exclusive calls will be advised in this service. Viewable research report for the recommended advice will be provided for positional delivery advices within 48 hours of recommendation inside your web login only. No reports for options, short-term calls like BTST, intraday or likewise. Stock details will be given in below format: stock name, advice price, target price, holding period, weightage allocation if applicable, stop loss, one-line reason for advice. Investments are always subject to market risks. For any query, call or WhatsApp on 9825306980. Subscribe now. Visit our website www.smartinvestment.in or email us on info@smartinvestment.in.
Okay, so that was a quick video regarding our service, that is best of smart services, as you all have seen in our video. So now coming towards our writer's introduction, Mr. Vijaya Kittu is a very multi-dimensional personality. And if I would say, according to current trend, which is going off Spider-Man No Way Home, it is like multiverse. No spoilers, sorry. So it is like a multi-dimensional personality. He is in stock market and financial services since more than 11 years. And he has penned down 2 books regarding stock market, which is foreign exchange markets and the basics of trade and commerce. He is also chief editor in management book series, which is perspective of business management and economics. He has many more degrees, which you might all can see on your screen. That is MBA, MA Eco, MSc Applied Physics, LLM, MSc Computer Science, MCA Computer Science, MA JMC, MA Education, and Bachelor in Life Science. PhD is also at doing PhD in management and business. I must tell one thing that ये सारे एक जन्म के हैं. So I don't know many person who has so many degrees in his portfolio. So really very brilliant and diversified personality. So I must say that we will all enjoy learning from his learning. So and we will get much more wisdom of him when the presentation forwards. So Mr. Vijay Kittu, everything hand over to you.
Thank you. Thank you so much for the smart introduction. It's my pleasure to be part of this program today. And all the participants here today have one common objective. We are here to learn, right? Learning gives us sustainability. It gives us a long-term edge. So we will, in the next 1.5 hours, 2 hours, we will discuss about what is long-term investing and how we can get the edge that we are looking for, right? So let me share my presentation. I'm happy that many of my old friends are also in this group today. Many of my old students as well are participating in this because my focus is always on learning. So there's nothing that there's no knowledge which I feel is useless. Knowledge we keep on accumulating, and we will definitely be able to use that kind of wisdom over a period of time. I'm basically a stock market trader. I'm a teacher, passionate teacher on the subject of finance. I'm a university research scholar as well. I'm doing my PhD right now. I'm the last few sem of my PhD program. And with the smart investment, I am with almost 4 years now. I wrote around 370 plus articles so far. I write for smart investment. I write for basically on the topic of smart banking and financial services. So I write for both the English and Gujarati versions of it. And I also write for Smart Plus newsletter. It comes on every Monday. The focus of Smart Plus newsletter, my column is named Updates on Select Stocks. So I focus on 5 to 8 stocks every week, which are in news, which have some fundamental story associated with that. And I also write for Smart Bonanza, where I take one good company, which I feel is worth long-term investing. And I present them in 10 simple points. My focus is that we don't have much time to actually digest a lot of information. So I always give in very simple bullet point kind of approach, which is very easy to read and understand. So I'm very happy that I'm associated with Smart Investments. I'm thankful to Dilip ji. In fact, it so happened, it's a coincidence actually that I was doing a webinar seminar in Ahmedabad a few years ago. And it was my pleasant surprise that Dilip ji has come to the program. Thanks to Nayan Patel ji of Rupee Gains as well. So both of them are guests for my program at that point of time, and that is how I got associated with this smart investment. Since then, our journey is very smooth. See, in the stock markets, there are times where we will be having the uptrend, and then there will be days where we'll have the downtrend, right? When you come to the stock markets, you should be very clear that you will have to sustain the first few years of choppy journey. Then the long-term relationship will get created and you'll be able to make wealth. So if you want to become successful, if you want to become wealthy with the stock markets, you need to have long-term commitments. That is very important. You need to survive in the first place. Many people come to the stock market. My experience is that they come here to make quick money. and unfortunately many of them are might not be having the necessary skills, or rather the patience levels for holding a stock for a long term, and ensure that compounding also happens to that, right? So with that note, let's get started. I focus on 10 factors today because time is limited for us. So we'll focus on 10 factors, and I'll give you some brief introduction to each of those topics, so you'll be able to understand it better. The first factor I look for when it comes to long-term investing is that the stock market is always there, right? The stock market is always there for us at any point of time. We have limited capital. Each of us have limited capital, and we have to carefully use our capital, right? So when we are using capital, the stock market is such a place that it is same for everyone, right? Whether you have just 1,000 rupees or a lakh rupees or a crore rupees or hundreds of crore rupees, it doesn't matter. The stock market is always there. It's the same easy, equal approach for everyone. But if you see our perspective, our role is that of an investor. So from an investor's perspective here, our risk appetite is limited. We cannot afford to take whatever degree of risk that we want to take. We should be very careful about risk management. While the rosy story, while the positive story is that we'll be able to make money very nicely, very simply, the other part of it is that we need to manage risk. So investing is all about managing risk and optimizing returns, right? So if you think that long-term investing is all about profits, it's not as such. My experience is that if you take 10 companies and if you take them for a 10-year stretch, you will notice that as many as one or two might get bankrupt, right? These companies won't even survive a 10-year decade period. So what we need to do is that we should, rather than trying to optimize and ensure that all the 10 companies that we have picked become rockets, we should accept that there are certain things which are not in our control, but there are certain other things which are under our control, which we'll be able to manage, and risk is one of them, in fact. Now, if you take market capitalization of a stock, this is one important factor I always consider. So when someone asks me about a good company to invest in, or when I myself think about investing, I will study my risk appetite first, right? And based on that, I'll choose the market cap, right? What does market cap tell us? For example, market cap will tell us about the size of the company, because if you see in the stock exchange list, all the list of companies are ordered not based on alphabetical order, but based on market cap. So, for example, if Reliance Industries is number one in the list, it means to say, as of now, Reliance Industries has the highest market cap, right? Now, market cap tells you two things. Market cap representation will be of two types. The first type is about full market cap, right? How many shares are issued? What is the current market price? Right? The second data point that we have is free float market cap. Only that market cap which is available in free float, which means normal retail investors, normal small retail investors like you and me, we will be able to also buy those kind of stocks. How much quantity of such kind of stock is available in the market? Now you may ask me, sir, where do I get this information about market caps? The best source for information about market caps is to go to bsindia.com. Always source your data from official websites. They are the first data points, first sources, official sources. There are so many other third-party websites available. Media websites are also available. They are secondary sources for you, right? So in general, always source information from the root, from the place where it originates, where the information originates. So my best source is to go to bsindia.com and find out what is the market cap, full market cap, what is the free float market cap, right? Now, if you permit me, I'll share you a browser window, my browser window, so that we'll be able to see what is the market cap of say, for example, Reliance Industries. So here I go to bsindia.com, right? So I search for the stock Reliance Industries, right? So I open Reliance Industries. So here I'll be able to notice market cap, full market cap. How much is it? It is 15, 83, 118 crores. What is free float market cap? Out of this 15,83, 8,07 is free float market cap, right? So these two data points are important for me to tell the size of the company. So I'll be able to notice, I'll be able to understand what is the size of this company, right? You take any company which is listed on BSE or NSE, you'll be able to get it from bsindia.com or on nsindia.com, right? So look at the market cap. That's the first data point for you, because you will be able to understand what is the size of the company. Now, it also speaks about potential volatility of a stock. Usually, in market cap, if you put the companies in terms of sizes, usually the top 100 companies are called the large cap companies, right? Company number 101. If you prepare a list, company size 101 to 250, we generally call it as a mid cap. And after mid cap, you have a small cap and micro cap, right? So if you see it, if you order them, if you put them into various, if you give them names, usually large cap companies will be less volatile, and small cap and micro cap companies will be more volatile. Now, what is volatility? Volatility is an important factor when it comes to investing. Volatility means the choppiness of a stock price. Will the stock go up very quickly or come down very quickly? How quickly will it react to various things that are happening in the economy, for the news, for the geopolitical activities, etc. So my understanding is that you should be very careful in selecting the kinds of stocks which come under a specific market cap. And this market cap also talks about market cycles. Some companies gain market cap in a bullish cycle or a positive phase, and they lose market cap in a downward phase. So you need to decide how many kind of seasonal or cyclical stocks can be in my portfolio, right? You need to market caps allows you to decide if your risk appetite allows you to own the stock or not, right? Always keep this in focus, right? I'm sure you may be having some questions. Any question that you get, please feel free to post that in the chat box. I'll be occasionally going through the chat box and try to answer them. And if it is not possible, maybe at the end of the session, I'll be able to take the questions from you, right? So rest assured, I'll try to answer as many questions as possible. Time is important for us. We'll make the best utilization of time, right? Now that I know the numbers, I have a small structure here. If you see, I have a table here which speaks about large cap, mid cap, and small cap, right? I have some parameters also on the left side. Now, what are the parameters I have? I speak about risk all the time. So we have risk or the probability of negative returns. So if you are dealing with large cap stocks, the risk factor will be usually low. I don't say there is no risk in investing. There is always a risk, whether you are investing for the long term, for the short term, or if you're trading, risk is always there. Risk is about uncertainty. We need to deal with this uncertainty, right? So the risk here is the probability of negative returns or maybe a loss. So for large caps, it is usually low. I am not ruling out the possibility that there is no risk. There will definitely be some risk. There are so many companies which are large cap companies at one point of time, but they lost their market cap. They lost their value. Some companies even got bankrupt, right? That is fine. That happens sometimes. What we need to do is we need to minimize such kind of occurrences and ensure that we are with the best of the best companies. And if you go to mid cap, the risk level will be a little high. When you're dealing with small caps, the risk will be very high, right? So if you are new to markets and you are thinking about long-term investing, don't be greedy for returns immediately. Returns are post-facto factors, which means after you invest, after the company performs well, you get returns, right? Returns are a result of the activity. That is not your input, or that is not what you get intermediately or immediately. So always focus on managing risk with your investment. So focus on good companies. If you're new to investing, start with large cap companies to begin with. As you gain experience, as you gain confidence, you will probably think about mid cap and small cap. Have a healthy mix of large cap, mid cap, and small cap at all points of time, right? Then the probability of exceptionally high returns. We want returns, big returns. What is the probability of exceptionally high returns? That will be low with large caps, unfortunately. This is because most of the so-called large cap companies are growth-oriented companies. The companies have clear visibility, they have plans, and most companies, in fact, the management, if you hear the interviews, if you read the newspaper stories about the company's performances, etc., these companies generally specify, they disclose, they try to project the future. They say, for example, if you take an IT company, the IT company says that we are going to get so many customers. This will positively bring us so much of revenue. Because of so much of revenue, so much of profit is possible in the next quarter or next 1 year or whatever it is. They give what is called guidance, right? So listen to all those kind of stories. So for large cap, because these are growth oriented companies, high returns might be relatively low. Then you have mid caps and small caps where the returns high probability of, probability of getting high returns is very high in those kind of companies. But you need to understand, if you take the small cap example, I am getting high returns because I'm taking very high amount of risk. So this is correlational. This is related to each other. So if you start with investing, start with the low risk, low return is also okay for me. So this is where large caps come into picture. And then you may be going into high risk, high return, and then very high risk and high return kind of, right? So it's a transition. You need to learn, you need to experience the markets and then gradually build that kind of structures. Then another important factor is liquidity. Now I invested in the stock market. I invested in equity shares. I want money immediately. For some reason, there's a personal requirement, so I want to sell my holdings. If you're looking for liquidity, large caps will have very good liquidity. What is very good liquidity? It means that if I sell a holding, I get my money very quickly. There are sellers readily available, buyers readily available. It's a very healthy buy-sell things happening every few seconds. But if you go to small caps, the gap between the buy price and sell price, we call it as ask and bid prices. So the gap is usually high. So that means to say they might not have good liquidity. If you take micro cap stocks or nano cap stocks, they don't have much liquidity. So that will lead to a problem where you cannot maybe able to sell all the holdings and then get all your money. So think about those kind of requirements. Your money management is also part of investing activity. So large caps will have very good liquidity, while small caps have relatively very low liquidity. One important factor when it comes to long-term investing is that we need information, right? Where are we? Are we with the company? No, we are not working with the company. We are not in the board of directors of the company. We are not employees of the company. We are not the stakeholders of the company. We are very far off. For example, if you take me, I stay in Visakhapatnam, right? And most companies might be in Bangalore or maybe in Bombay. I cannot go to Bombay and attend to the meetings, even if they allow me to attend. In fact, they don't even allow me. Most companies don't allow investors to attend the meetings unless there is an AGM or something like that. So there is no possibility that we go there and get the information. So all our information is based on disclosures that the companies give. So any interviews that the company gives in the media, any reports about from the company or from the industry that are being coming up. So we need to keep an eye on all these things. We need to read newspapers every day. My humble request is, if you don't know where to start, at least read the Smart Investment newspaper that comes every week, every Sunday. Sundays should be knowledge-oriented activities for you. Commit yourself some time, maybe 1 hour, maybe 2 hours, maybe 3 hours. So this time is very important for you. Read all the articles by all the authors. You will be able to get lots of insights about the company, right? So that is how you have to get information. If you have more time on a normal weekday also, definitely go to bsindia.com, download the latest circulars, download the latest announcements related to your own company and start reading the information, right? So the availability of information is usually very high when it comes to large cap companies. But when it comes to small cap companies, it is very poor. That means small cap companies usually disclose only that information which is statutory in nature, which is definitely necessary. They won't update frequently. They don't come up into the newspapers every frequently, etc. So that means to say that we might not get the latest information. Our information might be outdated. It might not be sufficient enough also. So that is the reason why when you're investing for long term in small caps, most of the value stocks will be in small caps. But unfortunately, you have to study a lot. You need to put in a lot of efforts to get to know the information, to process the information, and then stay invested with the company. So there is a very big story related to this. You definitely have to keep this thought process in mind. Now, Warren Buffett always says that investing is a simple process, but it is not at all an easy process. People know good company names. We need not have to speak about a specific company, but you take any good company. If you ask me, for example, is Reliance Industries a good company? Some say yes, some say no, that's fine. But it is one of the wealth creator for us. If you take TCS, for example, it's Infosys and TCS are like pioneers in Indian IT industry. They have such standards, global standards, in fact. So if you ask for one good name in a sector, everyone knows those names. It's not something secret kind of. But how many of us will invest in them? How many of us will stay invested with them? How many of them are patient enough to wait for these small companies to become big companies and make money? That is very, very few. Very few people will invest and stay invested. When there is a small adverse news, and when the stock falls down by 10-20%, we immediately panic and then we come out, right? Because we want to safeguard our profits. So when it comes to long-term investing, how does the investor react to the stock is very important. Right? There are some companies which are once upon a time wealth creators, but they are, because of some bad news, they're they're like wealth destroyers as of now. It so happens it's a cycle. You need to understand where is the company in this whole cycle and then understand. So when it comes to long-term investing, it is not at all an easy task. Dedicate some time and efforts, write your own notes, right? And then find out what works for you. Basically, when it comes to long-term investing, you are planting seeds, right? You're watering the plant, so sprouts come up. So you're watering, you're nurturing the plant, and some fine day it becomes a big tree. You're waiting for the tree, and it will take years together. It's not few days, few months. If you are able to make money in few months or a few years or 1-2 years, it is more of a coincidence rather than the company organically doing something to give you returns. For example, in the last 1 year, you take any stock, almost all the stocks in the market. In fact, if you take the Nifty 50 itself, it's like 57% return, right? In 1 year period, last 1 year return. So will it sustain? Will it continue to, will I be able to get the same 50% returns every year? Maybe not. Market will be going up, maybe will be coming down. We have to live with this, right? So take idealistic returns, expected normal expected returns, and anything that is above that is a profit for you, right? Is a bumper surprise for you, is a positive surprise for you. So when it comes to long-term investing, you should be patient with the companies, right? You need to quantify how grave is the negative news. If the negative news is one time, and the company is strong enough to overcome that negative news, you stay invested. People enter into companies and exit companies, but that is not a good idea. If your strategy is a short-term investing, then yes, that's a good idea. You can enter into a company and exit once your target is reached. That is for short-term investing. That's a different ball game altogether. That's a different strategy altogether. But if it comes to long-term investing, stay invested with the company. You will get confidence about the company only if you read them. So read as much information about the company as possible. Then you get the confidence to hold the company even in adverse times, right? For the last 1 week, market is bleeding, right? Market is down by 5%, 10%, whatever it is. And many of our stocks, our portfolio stocks are going down. Even our long-term portfolio stocks are also coming down. But that's fine. This is a part of the activity. Stock market goes up and comes down. I know that. I need to just ensure that my company is strong enough, has some solid story that I can still continue staying invested, and then I can continue with this. That kind of confidence should be there. In fact, the confidence levels for some people will be so much that they will take this as an opportunity to enter into a stock or to accumulate a stock. Please understand, for long-term investing, bad days, bloodshed days in the stock market, red color days are the best days to invest. The deeper the stock market falls, the better your investment possibilities are. Because we know market will inevitably go up. And when market goes up, your own invested good quality stocks also go up, right? It is just common sense. We have seen that statistics show this. If you see the Nifty 150 chart for the last decade, a couple of decades, there are so many days when the market has fallen down and have recovered also. So the market falls down and recover. India is a growing story. So over a longer For the next 1 decade or 2 decades, you will be seeing Nifty and BSE Sensex at a much, much higher level than what they are right now. But will your company be able to take that advantage? Will your company be able to survive and sustain these kind of down cycles also, so that it goes up? That is very important. So what is the average 5-year returns? What is the average 1-year return? Sometimes we'll be in a dilemma. If the last 1-year returns are red, and prior to that, the company gave very good returns, people will panic, will think twice. Should I stay invested with this company? Should I continue to invest in this company or not? Right? So this kind of confusion comes because you are stuck with prices. Focus less on prices. Prices are just numbers. You have to think about quality of a company. You have to think about longevity of a company. You have to think about valuations of a company. Those things matter more in the long term. What happens in the last 1 month or last 1 year may or may not repeat. But is the company moving towards positivity? That is very, very important for us. The second factor I focus on longevity or good quality companies is about the promoters and the management. Who are the promoters of the company? This is a very important question. What is the background of those promoters? How rich or poor are the promoters? How much knowledge do they have on the business that they are running? Promoters usually take the owners of starting the company, get them listed. Management is usually hired people. The top management are experts in a specific domain. For example, the chief executive officer, the CEO of a company, he's expert in managing the company. The chief financial officer, the CFO, he's good in finance. He ensures that the finance of the company is very strong. The financial structures are strong. The chief operations officer, COO, for example. So his focus is on how to ensure that the company's operational processes are right. So study the profiles of the management and how well are they managing the company. Keep an eye on these kind of things. As far as promoters are concerned, there are so many metrics that you can take. We can elaborately discuss on metrics. In fact, I take almost a 4 to 6 hour session separately on financial metrics or financial ratios alone. That's a different topic altogether. But when it comes to promoters, I look for the promoter holding in the company. This is very important. The higher, the better. And the promoter pledging. Promoter holding in the company is high, but how much is the pledging? That is an important factor. And as far as management is concerned, I look at their qualifications and their experiences. This matters a lot. But more than management, I give more importance to promoters. Right? So promoters first, then comes management factors. There's an interesting book. As a long-term investor, you have to read a lot, both about your own companies as well as about the subject. One nice book I suggest about this topic is called The Black Swan. It's called The Skin in the Game by Nassim Nicholas Taleb. So Taleb speaks something like this. If your own interest is not there in the company, then you will not feel the liabilities of the company. You will not optimize or work in the best possible manner. So that's the reason why if promoter's money is also run in the company, he will ensure that his money is protected, and in the process, all the stakeholders, all the investors' money is also protected. Right? So that is about the promoter's role. I'll also put the name in the chat box so that you can copy the name of the file, name of the book, so that you can take it. You can search on Google and then probably get this book online. Right? It's a nice book. If you can afford to buy this book and then read it at your leisure time, it would definitely be useful. Right? There are so many books, in fact, that you have to read. I will be very selective. I couldn't share them much here, but we'll do that. Right? We will be able to get these promoter details from various sources. From BSE India alone, you can get these kind of details. For example, we know that Reliance Industries is promoted by the Ambani Group, Mukesh Ambani. We just see their patterns. So if you are interested, you can go to this section called Shareholding Patterns. Right? I hope you are able to see it on the screen. So click on the Shareholding Patterns. You'll be able to see what is the promoter holding. So as far as Reliance Industries is concerned, there are 78 promoter or promoter group people or companies. right? And they totally hold 50% of holding in the company. So 50% of Reliance Industries is held by the promoter and promoter group, and the rest of the other 49 odd or maybe 50 odd percent is with the public, right? And if you're interested to see the names of who hold 50%, you can click on this link. So you'll be able to see how much Mukesh Ambani is owning and how much is Neeta Ambani is owning, and and the other promoters and their promoter companies also. Sometimes companies also become promoters and they own the shares. So you'll get to know these kind of details, right? So as I'm telling you, you don't have to go to some third-party website for all the information. Most of the information that is necessary is already there on bsindia.com or nsindia.com. All other websites source the data from here, and they do mathematical analysis or whatever it is. So if you know how to use this information, you will generally not depend on third-party company or websites or unknown sources kind of companies, right? So this is about the promoter and the management. If you see the promoter structures, BSE's, I mean, the SEBI's mandate is that for a listed company over a period of time, it has to ensure that at least 75, maximum promoter holding can be 75%. A minimum of 25% should be in free float, right? So most people, most companies, they need money. So that's the reason why they sell a part of their holding and then raise capital or for their own purpose, right? So these kind of statistics also help you in understanding. The third factor I look for in a company is its financial structure. Financial structure is very important for me because when I'm doing valuations of a company, I do what is called, I try to find what is called intrinsic value or a fair value of a company. Using some mathematical models, we need to understand what is the rightful price of the company. The current market price is the market discovered price. Usually market extrapolates things, right? So what we need to understand is, if I invest in this company and if I'm going to hold it for long term, considering the profits that the company makes, considering the cash flow that the company generates, if I do a reverse calculation and find out what should be the rightful price right now. If you want to find that out, that is what is called fair price or intrinsic value. It's a mathematical model. You need to study separately on that. That alone is a very big subject. Now, to determine the intrinsic value or fair value, you need some inputs. Some of the most common inputs that you need are financial data. You need to find out the revenue data of a company, the profits or the losses of a company, the cost and cost optimizations that the company does, the capital structure. What is capital structure? The capital structure is how much money is the company is borrowing and how much money is being raised in the form of capital from equity shares. So the capital structure is important for you, and ultimately the cash flows. Right now, where do I get this information? The best source for this information is the annual report of the company and the quarterly reports of the company. So definitely keep an eye on those things. Download those reports frequently. See, the stock market is very big. We cannot entirely study the entire market. So for your own invested companies, you focus much deeper about them in your computer, in your mobile phone. At any point of time, if you get some 10 minutes or half an hour or 1 hour leisure, you should be quickly able to open and download the reports and read them, right? Don't waste a minute of your time also. Time is very precious. Whatever the time that you are passing or just taking away, you cannot regain it. There are some situations where you will be not doing anything. For example, I travel sometimes for my seminars and webinars. So when I'm traveling in an airplane for 1.5 hours to 2 hours, there is no network at all for me. So I use that opportunity to read. In fact, I was reading these books and newspapers since my college days. Unfortunately, I'm not a good in academics, even though I was a long-term investor in the academics. I was like an average student all the time. So in the entrance exam, I got a very big rank. Being an OC student, I can't get it within the city. I got an admission outside the city, outskirts of the city, and every day I have to travel 1 hour to and 1 hour fro. So every day I have 2 hours of time wasted in the bus. So it is at that time that I used to read Economic Times newspaper. So at that time we don't have PDF versions on mobile phones, right? I used to read newspapers at that point of time. So my point here is, I'm not boasting about myself, but I'm telling you that you should be a person who should not waste a minute of your time also. So use that time for reading big things. For example, you download a book related to investing. You download an annual report, because for reading an annual report or for reading a book, you definitely need few hours of time. You cannot read one small data point and then go away and then come back, right? You need an hour at a stretch, or a couple of hours at a stretch. So those times are best times to read the annual reports. And from the annual reports, you get financial data. From the financial data, you will be able to compute the intrinsic value or the fair value of a company, right? The fourth factor I look for long-term is that the company's products and services. I focus on company's products and services. Do these companies' products or services have a longevity? Can they continue to make these things for the next 1 decade? Now, if you take a product, for example, will this kind of products will be there after 10 years also? Are the products having demand? What is the threat from alternatives? Is there a possibility that your model, your product, your service, the company's product or service will be replaced with something else? How much is the probability? You need to study those kind of things. Now I'll give you a small example. All the names of companies and names of industry sectors that I discuss in this program are purely examples. They're not any specific investment suggestion or thing. It's probably my own personal view, right? So you need to do your own due diligence and your own study before you take action about using this information. Now, if you take automobiles, automobile as a sector, for decades together, they were largely run on motor. So you need power in the form of either diesel or petrol, right? So all the automobile companies, you take very, very long-term companies like Tata Motors or maybe Ashok Leyland or Maruti, these are all petrol and diesel driven companies. Now, what is the threat? The threat is that we no longer want fossil fuels. We don't want to use coal and oil kind of thing. So we want to replace them. We want to use green power. So we want to move to electrical vehicles. So these companies like Tata Motors and Ashok Leyland, they have to change their manufacturing methods to bring in the EV kind of culture. But EV is again a competitive. It's already matured in other countries. Some companies made mistake. They didn't understand that EV will be the future and that petrol will continue to be the best thing. So they delayed their decisions. Some companies understood that in the initial stages and then took over the lead. So for every product or a service, this kind of threat will always be there. So what is the threat from the alternatives for my product or for my service? So, I mean to say my company's product or service. That is something we have to keep in mind. Then look at the sales growth. Are the sales growing? Why does sales grow? Sales grows because the company's products are in demand. The company is able to provide those products or services at a very competitive rate. That's the reason why it is growing. We want growing companies. It doesn't make sense to invest in a company which is bleeding and falling down, right? We want companies, our money can be best invested in companies which are growing, right? It's about alternatives. It's about finding the best choice for us. Now, what is the extent of receivables to the company? Sometimes the company's sales might be fudged or maybe shown in a different format or maybe are not reflecting the true picture of a company. So sometimes it so happens that the company delivers the product to the distributor. The distributor has not yet paid the money. The stock is stuck there. So the company show it in sales and show it in receivables also, saying that the distributor has to pay. That is again not a correct figure. So you need to understand how to measure sales performance or revenue data and take a quality decision based on that. What cost do buyers have to bear when switching to substitutes? This is important because it so happens that sometimes substitutes are easier. People change loyalties. People's customer tastes keep changing. So is the alternative product or alternative service available? Is it cheaper than this or is it expensive than this? So that is an important factor for us. So we will see how our companies are working so well in terms of products and services. So that's the next factor that I look for. Then competitors. Every company has a competitor or number of competitors. So if the company has to sustain, if the company has to stand tall and make wealth, it has to be innovative. It has to crush the competitors. It has to provide its goods and services at a very competitive rate. So what is the size of the industry? How many players are there? Is the industry growing or not? How easy or difficult is it to enter into that particular business or to exit from that business? Keep an eye on all those kind of things. right? Does the industry have a product differentiation, or is it one of the many, right? What is the size of the competitors? Is my competitor bigger than me? If so, what are their strategies? What is my company's strategy? What is my competitor's strategy? Because everyone has a market play, everyone has a market game. So what is the game that they have, right? What is the customer's loyalty to the brands? Are they brand conscious? Sometimes customers are brand conscious. Sometimes they are not brand conscious. For example, if you take pizza, Jubilant Foodworks, if you take Domino's, right? Pizza brand name is very important. If you have a local brand, that's an alternative, but people don't go there. People might not be so interested when you compare with Domino's. So they enjoy Domino's and Jubilant Foodworks probably enjoys customer loyalty, and they have a very good brand power also, right? Now, what is a threat to horizontal integration? Keep an eye on all these kind of things, right? So competitor things. The companies will have some bad times, but sometimes companies will have worst times also. So you need to deal with these kind of companies in your portfolio. If your company is involved in a fraud, when I say company, it could be management, it could be promoters or something, you need to be very cautious about those kind of companies, because we need to protect our capital before it wipes out, right? If you take a company like, say, just for an example, I give you, if you take Yes Bank, it's a very wonderful bank. For 14 consecutive years, it is a profit-making bank. Then there is some scandal or a fraud. It's not yet clear. So the government, it's in court, right? So promoters are there is a sense that promoters have defrauded, so they are jailed or whatever it is. So there are some cases where the promoters or maybe the management, or if they are involved with a fraud or a scam, that's an alert for us. We should be very careful of those kind of companies, and we should use parachute. We should come out of those kind of companies as soon as possible. If you're not happy with the company, just don't invest in that company. You have lots of choices, right? Just for the sake of names, ILNFS is one such example where evergreening of loans happened. Satyam Computers, where the financial numbers are fudged. Rico India, where the sales numbers are inflated. There is no sales, fictitious sales were put in that. Sun Pharma, there are some inadequate disclosures in the past. So be careful about these kind of companies where the company, the promoters, or the management are involved with a fraud or a scam. So to what extent am I sensitive to these kind of things depends upon your risk profile. So if you're a high risk taker, you can still deal with those companies. But if you're a sensitive investor, if you're a low risk investor, it's better to stay away from those kind of companies and find peace somewhere else, right? There are so many companies where the promoters are world renowned, right? They started Indian company, but the size, the scale, the technology, the reach is global, right? They are very many companies as such. So probably you're better off with such kind of companies where the promoters are globally renowned people, professionals kind of, right? Then I look for debt and financial performance of a company. Debt is something like a dual-edged sword. Debt is good and it is bad also. In particular, limited amount of debt is good. Debt beyond a normal threshold, if it is neck level, it is dangerous. So to what extent can debt be allowed or not allowed? You need to decide. Debt, sometimes it so happens that the company takes a loan intentionally because the cost of loan is cheaper, and it will be able to generate an asset based on the loan that is being taken. But it so happens that when you take a loan, when you take a debt, it also comes with a burden. For example, cash flows might get hurt. The company has to pay interest burden, right? Interest cost is also involved. The cost of the loans also differs from one company to another company. So you have to keep an eye on all these things. If you are a very sensitive investor, if you are very, what is called a very cautious investor, go with companies without any debt, if it is possible. There are so many companies which are debt-free companies. Probably that is a better idea. But if you know that the company's financial structures are well, it has a very good finance team, they know how to manage money, then taking a loan is not at all a problem. There are some businesses where you cannot do a business without a loan. For example, I mean, when I say loan, I use it parallelly with debt. So if you take banks, for example, banks are in the business of lending. To lend money, they have to borrow money, right? So sometimes it is inevitable. There are some companies who are very good in managing money. For example, if you take Reliance Industries has a very good financial controls in hand. So they are now more of into green business. So they have green finance, which means if the company is having a good sustainability score, it will get loans at a very low cost, right? So the companies have to decide, should I borrow or not to borrow? Should I use my existing cash, right? For expanding of the business or whatever reasons. So that is a very important consideration that speaks about the financial leverage of a company, right? Look for companies with strong balance sheet, right? The stronger the balance sheet, the flexibility the company has to do whatever it wants to do, right? So if your company, when you're looking for strong strength, then it's a very big subject again. Balance sheet studies is a very big subject. I regret not studying MCOM. Because MCOM is the place where you speak about balance sheets day in and day out. I, of course, studied MBA where I dealt with balance sheets, but I always feel that there is some part of missing things in my journey. So my point is, those of you who can afford time and who have a bit of money, definitely spend that money on yourself. They call it as investing in yourself, right? Invest in yourself. How do you invest in yourself? Enroll for a very good learning program. Maybe a university degree program if it is possible. I'm telling you, it's not at all a useless activity. It will definitely help out for you, but you need to understand, you need to realize, you need to find out, where can I use this knowledge for my activities? So when I'm doing my MBA and MA economics, I was able to understand how companies' balance sheets will be designed or structured and things like that. It's a very big subject, I'm telling you. You have so many YouTube videos and even dedicated books on balance sheets alone. But I give you 3 points that you have to focus on. How effectively is the company managing its receivables and inventory? So that speaks about the cash conversion cycle of a company. Then look at the revenue. How is the company's revenues getting generated? And what are the revenues part of the total assets of the company? So where is the revenue of the company in the bigger picture of the assets of the company? So that is given by what is called fixed asset turnover. You need to be very comfortable with mathematics, with financial ratios, with numbers, right? Warren Buffett says, if you are not understanding the finance of a company, if you are not happy with the learning part of finances, then you should better not take investment decisions, because finding a good company is one part. Investing in that good company at the best possible price is the second part. I don't say best possible price, but I would generally say the fair value of a price of the company. So if you want to determine fair value, you should have finance background. You need to acquire finance knowledge. By the way, I'm not from finance. My first degree is actually master's in computer science. So I'm from science background. I did my BS in undergraduate level. So even a science student can also learn all these things if you have interest. So don't tell me that you don't belong to the finance clan and so you don't understand anything. You have to spend time. You need to learn these things. Take it small, take in bits and pieces. Read one newspaper clip, one page of an interesting book. That is sufficient enough. Do it consistently. Your success is not a one-day story. You cannot become successful overnight or in one day. It's a longevity. I call my programs are called Kittu's Wealth Journey. If you want to make wealth, it's a journey. You have to spend lots of years, lots of months. You need to put in a lot of effort. There will be ups and downs in the process. You have to overcome all those things. So if you're looking for strong balance sheet, cash conversion cycle is one thing. Fixed asset turnover is second thing. The third one is return on assets. At the end of the day, at the end of the year, all the investors will be looking for one specific thing. What is the return on asset, right? How good is the company able to generate profits or net income? So that is what is return on assets. And there is a big story along with this. There are so many ratios related to returns. For example, some people like return on capital employed. Some people talk about most people will probably talk about return on assets, right? Some investors, equity oriented investors, they focus on return on equity part, because each of the stakeholder will be interested in one part of the overall business. So look for companies with strong balance sheet, right? Look for sustainability. the new theme right now is about sustainability. We have this UN declaration, right? So every company is now thinking about how can I save the planet? How can I add value to the other stakeholders, right? So if your company is dealing with sustainability topics, then it's very good. The company is aware of it. But if a company doesn't more care of sustainability, then you have to think twice about investing in this company. Please understand, most of the data we have is past data, right? Most of the decision making we have to do is in future, from now towards the next 10 years, right? What is the management's plan to sustain for the next 10 years? That is important. To give you a rightful perspective, let me give you an example of Reliance Industries again. Just again, an example. Now, Reliance Industries is into oil business initially, right? I speak very simple English. I don't want to use much of a jargon to the extent possible, because ultimately it's not a show that I know something. There should be some takeaways for you. Ultimately, this 1-2 hours time that you have spent, after you go home, write your own notes, just jot down the points and just go through them with your companies as examples. Say if you take Reliance Industries, it was initially in oil. Oil is very gold at that point of time. Later, we have seen this telecommunication revolution, communication revolution globally, call it internet, call it mobility, whatever it is. So Reliance has rightfully went into Geo, right? And it became a dominant player in the telecommunication business as well. But I don't know for how long this oil business will be. Because globally we want to reduce the uses of fossil fuels. So we want to reduce the use of oil. So what do we use? We will probably, energy is necessary, power is necessary, but how are we generating power? We have to generate power from renewable sources, from those sources which do not harm the environment, right? So Reliance Industries changed its strategy. Now it's building 5 gigafactories in Jamnagar, right? This will take some 2, 3, 5 years time. Once the factories are up and running, they will generate power. It could be solar power, it could be renewable, whatever form of renewable power it is. They have a very big strategy about that. They are into energy, right? Oil is an energy. In the future also, they will be continuing with the energy business. But look at the way they have changed their business. They are investing crores of rupees today. It is not at all a free money. It is not a cheap money. They are spending money on this. With the money that the company is spending, it is guaranteeing it. It is creating a sustainability for itself. When the company is sustainable, if the company survives for the next 1 decade, and if you stay invested with those kind of companies, you will definitely be able to make money. Please understand, companies have to sustain first, and then they'll make money for you, and then they'll make wealth for you. So if you take the sustainability chapter from Reliance Industries annual report, this is a small screenshot of it. So Reliance Industries understands business priorities will coexist with social commitments, right? And our activities support inclusive growth. So the business has to grow, and the social growth also has to happen. The society also has to grow. So there are interesting chapters in this annual report. If you read, you will be able to understand. So my humble request to all of you is, take your Demat account, look at the names of companies, download the annual reports, or maybe go to the official website of those companies and find out if there is any topic related to ESG or sustainability, and what is the company's plans towards that, right? That is information. You need to convert this information into knowledge. You have to determine whether it is a good positive move or not, or if the competitors are better placed than my company, right? You have to think about those kind of things, right? So that is about social commitment and the sustainability of a company. And ultimately, I always think that some part of the story is company's story. If you know a good company, if you invest in a good company, you'll be able to make wealth. But the other part of the story is our investors' perspective towards the stock, right? How do you react to the stock is also equally important. As Warren Buffett was saying, if you are investing in a fundamentally good company, the time frame, you don't have a specific time frame. It's forever, because the companies, competitors come in, but these companies managements know how to overcome those competition, right? So if you're looking for long-term investing, the best time is to invest forever. So valuations are a secondary factor. The company's quality is the primary factor. So that's the reason why I have intentionally used the word called good, right? So good companies, keep them use your favorite investing strategy. There are so many strategies available to you, right? Ultimately, you gradually or maybe in a single go, you deploy your money into those companies, right? And once you are invested, just hold the company tight, right? If the company quality goes down, if the company is no longer of a great quality, then do not hesitate. Exit from the company and move your money into a good company. So how to determine that the quality of a company is coming down is very important factor. It's a very lengthy subject also. Again, using the smart investment banner, we will definitely come back. We will definitely discuss about that in a later part, right? Because this is a very big subject. The long-term investing subject is very big subject. It has so many individual domains and departments, right? And some people invest when they say long term, they invest in lump sum and they hold forever, hold for as long as possible. Some people, they say they understand the volatility of the market, so they say I'll use cost averaging approach. I use monthly SIP approach. Some people, for example, they follow what is called buy on dips strategy, right? You use whatever strategy is your favorite strategy, and ultimately always keep an eye. Once you are invested with the company, keep an eye of deviations. If there are any deviations, not on price but on the quality aspects of a company, if you are not happy with the quarterly results, or if the market dynamics have changed, then you definitely have to think twice about the company. So to what extent shall I wait before it is too late is again a factor of risk. If you're a conservative risk taker, you are very sensitive about a company. If you are not a conservative investor, if you're a risk taker, you give some lenience, you give some extra time for the company. Sometimes it works out, sometimes it doesn't work out. So if you take a 10 company portfolio, if you are able to survive for 10 years with at least 8 companies, profit making companies, 8 companies making wealth for you, that is sufficient enough. 2 companies might get bankrupt. Your capital invested in those 2 companies has completely eroded. That is fine. It's a part of the game, right? So you cannot do anything about that, unfortunately, right? We did all our best analysis. We have put in all our efforts, but still the company is only coming down, and it's never coming up. The company's management is also more of troubleshooting every day rather than giving a sprout or a positive development. If that is the story, then stay away from those kind of things. So ultimately, stay away from bad things, stay away from bad companies. The sooner you realize that this company is a bad company, just exit from that company. And every time you put money, think twice. Am I investing in a company that is for the future, that is very good? Do I have the confidence that this company can use my money for betterment and that it can survive for the next 1 decade? That is very important thing, right? So company's approach is one part. Investors' approach towards the company is another part. So together it will help out for you. Together, if you combine this kind of knowledge, you will be able to make good amount of money with the stock markets, right? There's a learning curve, so it will take some time. So implement those kind of practices very strictly. Prepare your own set of rules. Prepare your agenda, your kind of risk profiling, and then probably find out those kind of things, right? So with this, I come to the end of my presentation. I'm sure you'll have so many questions. I'll be able to take some questions maybe for the next 20 minutes or so. I'll be able to take your questions. I don't have access to the YouTube channel right away here, but if it is possible, maybe someone can give me questions from the YouTube channel also. I am already seeing some questions in the chat box, so I'll be able to try and answer some questions here. Heji, I think some of our friends also can unmute themselves and ask a question if they wish to. Can you?
Yes. I will just unmute all so that they can. Yes. Now participants can unmute themselves one by one. Just raise your hands and we will address you, and so that we can go for question answers. Please do not unmute all at one time, otherwise it will create disturbance for others also. So just try to keep the quorum as possible, and just raise hands, so we will address accordingly.
To begin with, there's a question from Sanjit Sutar in the chat box. Yes. So he's asking about investing in a company which are always in upper circuit and lower circuit. Very good question, Sutarji. Yes, there are some companies which are always in upper circuit or lower circuit. Maybe, not sure, but maybe these kind of companies might have some operators' hand in that. Maybe these companies are in surveillance by SEBI or something like that. That's the reason why circuit limits are put in the place. So you have a 20% circuit filter, and if company always hits 20% circuit filter, then SEBI is a very good regulator. They will reduce it to 10% and then to 5% and then to 2%, right? So let the company stabilize. Price is a secondary factor for us. So the price is linked to valuations, but more than that, before judging a company, study the quality of a company, right? So look, the quality of a company is more important for you. Then comes the price of the company, right? Yes, someone has. Many people have raised their hands. How do we do that? I'll unmute one person. Maybe Patelji can take this opportunity to ask a question. Patelji, you're free to speak now.
Sir, semiconductor company ko hai?
See, you need to understand semiconductor is a small theme, right? Theme means when you are investing, you speak about thematic investing. There are so many companies in almost every sector. It's not a sector
Big
where
company,
there are
sir.
no
Big
companies.
Achhi company.
Achhi company, you have to again study and then decide. Look for, see, I don't specifically invest in a specific semiconductor industry, but I ensure that one company in my portfolio might be already interested in that business or maybe already having some exposure to that business. I'll just give you an example. There are some, see, semiconductor story is currently in flavor because there is news associated with this. After a few days, what happens to the news? News will go off. But the semiconductor business is not a small business. It requires crores of rupees of investing. It's not a business where there is no competition. There is global competition. If you take Taiwan, for example, if you take Korea, for example, they are much bigger players than India, right? So this is a high technology area because the technology changes very frequently. So I don't specifically invest in any semiconductor business, but I will ensure that at least one company in my existing portfolio has an exposure to semiconductors. For example, if you take my portfolio, probably I'll think about Tata Motors. Tata Motors has a plan to indigenously build their semiconductor manufacturing. It's a self-sustaining. So if you take any Tata Sons company, for example, Tejas Network, for example, is dedicated to semiconductor manufacturing alone. And Tata Group, for that matter, has very big interests in building semiconductor chips because for their own business they need there's a lot of requirements, right? So I would please understand the theory part of it. Please understand the broader objective. My understanding is that India takes years together to become competitive as like a Taiwan. So if you take a long-term perspective, semiconductor is a short-term opportunity only, but not a long-term opportunity. Rather, invest in a company which is a long-term oriented company, which also has interest in semiconductor. So you're not losing an opportunity. If a government policy is available, all our companies' managements, they know how to take advantage of it, right? So that helps you. That is how you can take advantage of it. I hope I answered your question, sir.
Thank you. Thank you.
Yeah, I'll take one more question from the chat box. There's a company about Sushil Kumar is asking this question. It's about BHEL, right? When will it trade above its book value? Sushil ji, very good question again. This company called BHEL is from the capital goods sector. Capital goods sector is again a very competitive sector with a very tough margins for the companies. I cannot speak about specific companies, but if you see, there are so many companies, particularly in the capital goods sector, where the book value is eroding over a period of time. So unless these companies develop something new, enter into some new area, which is more sustainable to them for the next few years, it will become very difficult for such kind of companies. So when it comes to long-term investing, look about the future of this company. If you feel that this company will get a glory again and that it has a future, then it is worth investing. Book value definitely is one factor. Then again, if you are looking at book value, it means that you are a conservative investor. So you should look at those companies where conservative things are happening. But if you are investing in BHEL now, it is like aggressive investment. So you should be very careful with those kind of companies, right? There are some friends who have again raised their hand in the chat box, so we'll give a chance to someone else. Maybe Rajesh ji can take this opportunity. Rajesh Jain ji, please go ahead with your question, sir. You're unmuted now.
Sir, I have bought a Bunjal Showa.
Okay.
Everything is good now. It's paying a dividend, it's a good company. Management is good, but the rates are not going up. What's the problem I've done in the choosing that company? You can just suggest anything about that.
Okay. I cannot give you specific.
No, what thing I have missed in that balance sheet or something like that way? Because it is a very good company on my part. I have checked everything, but it doesn't move. It's a Hero Honda Group company.
Sir, you need to understand what is the products that this company do.
Okay, it will show us means shock absorbers.
Okay, and who are the leaders? What is the market space? What is the business area for that?
It's a Hero Honda, applies to the Hero Honda directly.
Fine. I mean, that is about the promoters or the management of the business. See,
Okay.
this Munjal Show, as far as my understanding is there, it's an auto ancillary company,
Right.
auto ancillary companies is a very big crowdy business, right? Almost all the companies are in mid cap and small cap segment. Very few of them are actually very, very strong big companies, right? And there are so many positives also, as you said, about this company. For example, the company is a debt-free company kind of, right?
Yeah.
But
small equity, it has a small equity. It has a good reserve. Everything is good in that, but it doesn't move.
No, this
what
is
I have missed in that. I don't understand till now. I am invested for last 15 years.
No, for the last 3-5 years at least, the automobile sector is not that great, and things are drastically changing. So look at the sales of the company. Is the sales growing? If the sales are growing, that gives you the confidence that this particular company.
Last quarter it has become doubled. Revenue has become doubled.
Okay.
So I'm just missing it. What I missed in the balance sheet, I don't understand now also. So nothing has gone wrong with the company.
No, sales growth is a problem. But if you see the sales growth, if you see the 3-year sales growth, it is negative sales growth. The 12% CAGR it's losing. And even if you see the 10-year period also, the company is losing at the rate of 2% CAGR every year, which means to say sales are not there in the first place. So if the sales are not there, then it cascades. So the profitability will be in pressure, and the stock price appreciation also will be in pressure.
Should I exit from that company?
Pardon, sir? Sorry?
Should I exit?
No, I cannot give investment decisions here, but
I'm not giving investment. So as per you, the CAGR
that is the nature of the company. This is what I'm actually talking about. See, what is the market cap of this company? It's a micro cap or maybe a small cap. What is the business of this company? It is an auto ancillary, which is a second level business. The primary businesses are automobile companies. The secondary level is auto ancillary. So it always comes with this kind of risk, right? I cannot speak in specific about a company because unless I study myself about this kind of companies, I cannot really speak about it. But if you're not happy with this company fundamentally, then for long-term investing, holding an average company or a below average company.
15 years, I bought at 28 rupees, 28 to 38 rupees. It went till 310, and now it has come back to 120 now, I think so nowadays. But I feel that company is very good. But as per your suggestion, the sales are going down because of this Corona.
No, it's not just about Corona, but if you take the last 10 years also, it is minus 2%. So the sales were coming down for even before that also. And it's a very competitive business. Maybe the products or services are not competitive or as per the requirements of the current market or things like that. It's a very broad subject. I cannot really speak out very quickly and easily as such. But this is something that you have to definitely consider. If you're not happy with the company's performance and the future of the company, you should definitely move to a much safer and a better company.
Right.
Doshiji, Vraj Doshiji is next. Sir, do you have any questions, sir? You're already unmuted, so I was asking about that. Fine, not a problem, sir. Next to go is Vishnu, P. Vishnu. I'll unmute you, sir. Please go ahead with your question.
Yeah, good afternoon, sir.
Very good afternoon, sir.
I'm audible?
Yes, you are totally audible.
Yeah, sir. Like my question is, how to go with the new IPOs that are coming right now? On what basis we need to choose them?
It's a very big subject. We had a program, I believe Smart Investment also did a program on IPOs alone sometime back. But I'll give you very quick things.
Yes.
Most of the IPOs come when the market is at peaks. So now that the market is peak, they want to use this as an opportunity. If I want to invest in an IPO, when I say I'm investing, it's more of a long-term investment. I look for some basic fundamentals of the company. What is the purpose of the IPO? Is the IPO come if the IPO has come because the company needs money for its business expansion, I look forward to those kind of companies. But if the company has come, or if the company has come up, or the management has come up with an IPO because the promoters want to sell and take advantage of the market circumstances, then I'm less interested in that. I also will look at companies which are profit making already. I don't want to invest in a company which is already loss making. That will drain my own resources, right? Most IPOs, most companies which come for the IPO, they are dressed, they are prepared to appear good so that they get the SEBI approval and the investors' confidence. So keep your play with IPOs to a limited extent. When it comes to long-term investing, the sustainability of the company, as I'm telling you, is very important. The competition of the company is also very important. For example, if you take new generation internet-based businesses, for now there are some reputed brands, but these reputed brands, they can be overthrown very easily by another new company, right? These internet models, internet-based businesses, etc., can be easily replicated, and India is a very price-conscious country. So with the price or discounting mechanism, the market share can be gained very quickly and very easily, and your invested company might go off. So be very careful with them. Valuations are very important. If the company's valuations are very expensive valuations, stay away from them. See, I may be wrong in sometimes, but I don't hesitate to stay away from those kind of companies. There are some companies these companies are loss making already. They don't have a visibility for the next decade or so, yet they are enjoying a very good premium. The stock price is also going up at the moment. But please understand, you have to create your own set of rules. Your rules dictate the future of your portfolio. Don't look at a short-term opportunity alone. When it comes to long-term opportunities, the company's sustainability is very important. Most internet-based businesses will bust when a new competitor or a better business comes into picture. There are several thousands of companies which are into internet business, but how many Amazons and how many Flipkarts are there? They're very few in number, right? So longevity of the company, the differentiation of the company, these are very important factors for us, right? So keep those things in mind. I hope I answered your question, sir. Right. So we'll go to the next question. Nirav has a question. Nirav Bhatia is asking, is any way to find real value or worth of any share? If yes, how do we calculate? Niravji, yes, we have so many methods. We have almost 6 to 12 models. We call them as valuation models. For example, if you take price of a company, we have the discounted cash flow model. So you take the future cash potential of a company, do a reverse calculation, and arrive at a fair price of this company. So the real value or the worthiness of a share will be determined by the fair value. There are so many models. You can YouTube on that, or maybe on Smart Investment itself, we'll do a separate program dedicated to valuation methods. Right. So if you have time, just Google out, download some ebooks, or maybe you can search on YouTube also about a discounted cash flow model, for example. That is one of the first to begin with, right? Sandesh is asking about unlisted shares, if we can invest in them. My view is that as a small retail investor, they are very risky businesses. We do not know whether the shares are rightful shares or not, because there is no trading activity in those shares. We cannot judge whether they're the right shares or not. So I stay away totally from unlisted companies. For me, I'm a small retail investor. My capital is very small, and I have to be very careful in using that. I'll be greedy. If I'm a high risk taker, then I'll probably go for unlisted companies. But in most cases, I will stay away from unlisted companies. Forget about unlisted companies. I'm saying stay away from IPOs also to the extent possible. Only choosy specific IPOs are what you have to go for. Where the companies are very good companies which have a longevity. So your risk is more important ultimately. You're answerable to your portfolio. You are the fund manager of your portfolio, right? So that is it. Now I'll give a chance to Sridhar sir. Sridhar is available. So I unmuted him so he can ask this question.
Hi, sir.
Very good morning, sir.
Sir, your view on AMC sector and insurance sector for next 10 to 15 years. How's your view, sir?
Very good question, sir. These insurance companies and asset management companies, they come under non-banking finance services. So I definitely will need one company from non-banking finance services, or maybe 1 or 2 or 3 companies from NBFCs in my overall portfolio. Now, I will probably consider AMCs, but AMCs are very competitive business. If you see, there are so many AMCs which are competing with each other, and the top 5 will usually take away the market share. AMC is a size business, so as the size of the assets of the AMC business increases, their profitability also increases. It is a very competitive business. It may or may not be suitable for everyone. But insurance as a sector, because of the government's push towards insurance also, it is more important to have insured life first, and then we will probably need the investment part of it. So definitely, I will give more preference to insurance sector over the AMC. But high risk takers can probably consider both. Yes, if you take a decade view, both the sectors will have good opportunities there. You can definitely consider them. Okay, there's a question from Ravindra, right, in the chat box. So let me go through that. Give me a second. Yeah. So Ravindra Jadhav is having this question. He's saying, instead of searching mid caps for multi-baggers, can we average blue chips of high ROE, high ROCE, and high ROA, but when they come at reasonable PE in correction? Definitely yes, Ravindra ji. The choice of market caps depends upon the risk threshold of yours. So when you are shying away from mid caps and you're preferring to large caps, it implies that you want safety, right? Yes, these are 3 inputs, but it's a very big subject again. There are large caps which collapsed also, right? We have to keep those in mind. For example, Reliance Communication is once upon a time a large cap. It is now a micro cap or a penny stock now. So I can't just say that market cap is the only factor. Market cap is more of a risk factor for me, risk management factor for me. So if you're looking for a decade view, even mid caps also should be okay. You should be comfortable to have small amount of mid caps to get confidence in the first place. The volatility in the prices or the changed volatility in the results of the company, this is seasonal in nature. So study the company very closely. You'll get more confidence whether the company will sustain those kind of negative factors or not. So if you're a conservative investor, definitely large amount of large caps will be there. Fewer amount of small mid caps can be there, and as you gain confidence with those mid caps, you will probably venture more money into that. So you should be studying your companies more closely and more deeper. That's the point here, right? Mid cap companies are future large caps. So the size, these companies have a potential to grow, right? But you need to be very careful in selecting those companies. So you have to study those companies, and then you'll be able to understand that, right? Okay. Okay, there are many more people who have raised their hands. Maybe B. Raviji can take the chance to ask a question. He's already unmuted.
Yeah.
Please,
Sir, I would like to know your view of the impending Omicron virus and its spread on the market.
Sir, with the COVID wave 1 and wave 2 that came to India, we sort of kind of now have more confidence in facing those kind of things. Yes, it is a challenging situation, but at least the outlook is such that we will not go back to lockdown kind of situations again. India as an economy has done so well, as a country has done so well in overcoming the COVID crisis kind of. And if, say for example, tomorrow, God forbid, something goes wrong and this Omicron goes, it becomes a new wave for us, new pandemic for us, and that lockdowns would be put in also in place, the market definitely will crash again, and we will take it as an opportunity to invest. We already have a portfolio of companies. Our good companies should be accumulated at those kind of things. So if the possibility, my feeling is that the possibility of a lockdown kind of situation is very rare, at least as of information that we have as of now. The turbulence that we see is a normal side effect kind of, because after seeing the last 1 year bull run, it is a healthy thing that is happening in the market. And this is a part of the whole activity. It's a part of our activity. So we have to, this volatility or this market correction that is happening is a part of the game. So we'll accumulate some more good companies in this process. Right? I hope I answered your question.
Thank you.
Yeah, there are some more questions in the chat box. I'll take one question from the chat box as well. Okay, there's also a poll put before you, right? You can probably answer the poll question also, right? So the question in the chat box is something like this. This is from Kiran Deshmukh. Okay. Okay, he's wishing about, he's very happy about the program and he's giving some positive words about it. Thank you so much, Kiranji, for attending this program. Thank you so much for being with Smart Investment. See, we are all people who study. So with more knowledge, more reading, we get more knowledge. With knowledge, we get wisdom. So it's a time-taking process. We'll definitely do that. Then Murugesh, yes, is asking this question. Is there any checklist to find multi-baggers? So the concept of multi-baggers is a catchword kind of thing. If a company makes wealth for you, that itself is a wealth maker. It itself is a multi-bagger. The price reactions, the price initially might not move for most of the stocks. If you are with good companies, good profit-making companies, these profit-making companies, see, the share price is a reflection of profit-making ability of a company. So if these companies make profits for you, if the companies have good management, if the companies are entering into those areas which have future, it itself will be a multi-bagger if you stay invested with them. There are many large cap companies which are multi-baggers, there are many mid cap companies which are multi-baggers, right? It need not be that if I want to become wealthy, if I want to pick a multi-bagger stock, I have to start only in the small cap or mid cap. The success rates of a company from a micro cap becoming large cap is very, very difficult, and very, very few people have the guts to hold the company for such a long time. So those things are also important. Yes, you can prepare a checklist, or if you invest in a very good, fundamentally good company, that itself will be a multi-bagger. So I have my students, they evaluate a company based on 45 parameters, which we feel like a normal, typical small retail investor, we can do that. You can get them from the internet also, right? Next, yeah, please go ahead.
We also have some questions on YouTube, so wonderful. I will just paste them in our chat box so that you can address them.
Sure, definitely I'll do that. Screener is definitely one good website. Screener is one of the oldest websites, very simple, no ad kind of an interface. You can definitely use Screener, but can I use the Screener for quality aspects? When I say Screener, I'm talking about screener.in website. Okay, so screeners filter you, but you have to again do your own filtering, because qualitative aspects of a company cannot be screened, right? You have to study the company, get some inputs from the things, and then based on that you will be able to understand, right? So that is it. So there is a question from Hariharan Sitaraman. This question is from the YouTube channel. Thank you, Hariharanji, for participating to this program via YouTube also. I'm sure you will give a like for our Smart Investment YouTube channel and get alerts also, right? So his question was that, what's the problem with AMC's companies? Why is it hitting 52-week low? I exactly do not know the reason, but my view is that as a sector to speak, AMC business is more of a size and scale business. So so the profitability, if the AMC companies want to make money, they have to reduce the returns for the investors, the mutual fund investors, I mean to say. So it's a win. It's a process where if the AMC wins, the investor loses, the customer loses in this case. If the customers have to win, AMCs have to reduce their profits. So it's a very typical situation. So competition has increased in the AMC business. Many new players have come into place. SBI, we are aware that SBI mutual fund is also coming up with an IPO shortly. So we have around 40 plus companies. So it's a very tough business. So maybe it is something like that. Once we get a confidence, inflows of money in AMCs are very decent. In fact, if you see the recent newspapers, yesterday's newspaper, mutual funds are having the 9th consecutive month of increased inflows, right? So basically the competition, the choice availability for the investors in the listed company space in AMCs, probably that is the reason for that, right? Then one more question was we'll take from the chat box again. Ashwin is asking about the time frame for short term, medium term, and long term investing, momentum and long term investing. See, time frames for investing is very difficult. For trading, yes, we will be able to probably decide. For example, if you take momentum, for example, as a factor of investing, it's more of a short-term trading or short-term investing activity. You take advantage of the trend, for example. As long as the trend is profitable for you, you stay invested with that. When the trend changes from bullish to bearish, you will probably exit from that, right? Then similarly, if you take short-term investing, it typically will be for a 1 month period or maybe 3 month period. That's a very short time frame. If it's a medium term, it's from 3 months to something like less than a year. More than a year is officially long term. This is like textbook meaning. But if you're a long-term investor, if you really are serious in making money and wealth over a period of time, you definitely have to stay invested with the company for extreme long terms. So as Warren Buffett was saying, you have to stay invested forever. So I'll enter into the company, I'll stay invested with this company as long as it is fundamentally good. Right. So when I speak about long-term investing, I cannot say that 1 year. 1 year is like the income tax department's capital gain number, right? If it is more than 1 year, it is long-term. I cannot use that logic here. For me, long-term investing is staying invested for as long as possible. If I have a doubt that it is not a fundamentally good company, I'll definitely come out of it. I will not hesitate. For me, quality is more important. So if the company is of good quality company, stay invested. If the company is not a good quality company, you have a choice. So find a good time to exit from the company and then move your money into something better, right? So I'll take one more question from the YouTube channel. How to identify stocks which can be purchased for long term? In fact, the 10 points are actually the checklist factors: your market cap, the quality of the company, the promoters and management, the financial strength of the company. So these are the factors that you have to basically check, right? Karthikeyan is asking this question about mutual funds. In fact, this program is not about mutual funds. We have to stick to equity shares alone. But since you have raised the question about the mutual funds, just to answer your question, this is the only question that I'll take about mutual funds. I did a PhD. I'm doing my PhD in mutual funds, so I can keep on talking about that forever. But there's a newly launched scheme called Nippon India Taiwan Fund, which invests in Taiwan as a country. Taiwan is a country where you have around 65% in semiconductor business. So when you are interested in investing in semiconductor business outside India, and Taiwan is one of the best places for you. And Nippon India Taiwan Fund, it just came out of the NFO. So that's one of the scheme that you can probably study. And then if it is suitable, you can invest. If your risk profile provides you that opportunity, you can invest. My articles on smart investment, I write it in the name of smart banking and financial services every week. So the first 2 points will be about some interesting mutual fund schemes and upcoming mutual fund schemes. I'll just mention only 2 points in that. So do touch base with this smart investment every Sunday, and you will get updates on that also. Now Vikas Raja is asking this question in the YouTube channel. Vikas is asking about EV business and hydrogen fuel business. Very interesting question, Vikas ji. Now, there can be several companies who are dedicated to EV business or dedicated to hydrogen fuel business. But please understand, if things don't go in the rightful way, these companies are the first to suffer, right? So I don't suggest you it depends on the risk appetite of the investor again. Generally speaking, look at your existing portfolio. Is any of your existing company having a view about EV business or having a view about hydrogen fuel business? If that be the case, yes, it is a sustainable company, you stay invested with that company. Instead of investing dedicated to EV business or dedicated to any such technology or such factor, I'll give you small examples to understand better. I invested in a company called Tata Motors, say for example. And Tata Motors, their business is about automobile manufacture. Call it passenger cars or light commercial vehicles or heavy commercial vehicles. Now that the global trend is towards EV, they have to switch towards EV. So Tata Motors might have realized it a little late, but they went into that. As far as Indian EVs are concerned, they're one of the first to enter into that. Looking at the size, the scale, and the opportunity, it's not just Tata Motors is not just an Indian company, it's a global company. We have this JLR also, which is a luxury brand out in the Europe and outside India, right? So JLR is a very big brand again. So I will probably invest in those Tata Motors over a smaller company, a micro cap company, which is into EV business, right? I prefer those kind of business because if tomorrow EV is not successful, say for example, and some new technology has come in place, Tata Motors has the scale to quickly change from one kind of business model to another business model. So that is how I prefer those kind of things. The second company, the second sector or maybe the business area is about hydrogen fuel. I was studying this company, Reliance Industries, and they have very big business interest in hydrogen fuel. Probably, I think that amongst all Indian companies, maybe Reliance Industries and BPCL will be the first companies to really put something in on ground level, a product or a service related to hydrogen fuel, because they are investing their money into those kind of business areas. Then again, we don't know unless it realizes, we cannot come to know. This is a little futuristic to speak. But my point here is all the themes, the trends that you see in the news that comes in the market, if they are suitable themes, your company, if it is a good company, will take benefit of it. You don't have to specially invest exclusively of it. When I'm doing exclusive investment in that, it is risk-taking abilities again, right? Shall we give any chance to anyone who raised their hands? I see so many people. Guru Rajji, I'll put you to unmute. Maybe you can ask your question.
Thank you, sir. I'm having one very basic doubt that how finding intrinsic value has many many ways are there, but how to what way we have to follow to find a good company for a long-term investment at a better price?
Very good question, Guru Rajji. Determining intrinsic value is based on projections, right? Projections are estimates, future estimates. So I estimate that the industry grows at so-and-so level. I estimate that the company, if it takes advantage of that business opportunity, will grow at this level. Its cash flow will be at this level. And based on the cash flow, this is what, if I do a reverse calculation, this is what is the correct fair price. Please understand, there is no single model which is very correct or very accurate, right? So it's like in technical analysis. Like in technical analysis, you have so many tools, but you cannot say that this is the only tool I follow all the time. You cannot do as such. When the choice is wide, when the tools available for finding the intrinsic value are wide, you have to take a consensus. So find out where are the estimates going towards, where are they polarized towards, and based on that, you decide which is the best price. There is no single price as a fair value. It's an area. In fact, everyone knows this subject. Everyone knows how to find an intrinsic value. So everyone are waiting for that number to come, but it will never really come. This is because they enter into those companies prematurely. So for longevity, for long-term investing, intrinsic value using the price is definitely a good factor, but it is a secondary factor. Look at the quality of the company, then look at the valuation aspects of a company. And the answer to your question is take consensus. If you take 6 models, if 4 models are saying that 120 is the best price, somewhere between 120 to 150 is the best price, go ahead with that, right? So don't wait. If you know that the company is a good company, don't wait for the price to come. You are wasting your time in doing so. right? So if you're feeling that if I put all my money at this price, I will be getting stuck, then use a different kind of strategy. For example, buy on dips strategy, some people use. Some people buy at 25% now, and as the market falls down, they deploy the other 75%. Some people take a 10-year view of a company. So in the 10 years, I'll take 1 year as 1 or 2 years as an accumulation opportunity. So in 1-2 years, the first 2 years, I slowly accumulate and then hold the company for the next 8 years. So find out a strategy, whichever is suitable for you, according to your own earnings and cash flow, you decide the way forward for that. Right? I hope I answered your question, sir. Yeah. So I'll just go back to the chat box. There are so many questions in the past. One question is from Sushil Kumarji. This is about what's your view on JP Associates. JP Associates is a classic example of companies not to invest in, because my understanding is that if you see the future of the company, say for example, I want to invest in long term for JP Associates. The short-term view might be different. The technical view can be different, right? If you want to invest in JP Associates for the next 10 years, you ask the company the question, or ask yourself, find that out from the internet or from whichever sources you have. Whatever business that the company is doing, does the business have longevity? Who are the competitors? Can this company beat the competitors and become a market leader? I give 10 years time. I'm ready to put some money. I'm giving you 10 years time to the management. It need not be JP Associates. It can be for any company. I'm just giving an example. If I give money, if I give time, does the company have the ability to use my resources? Is it in a good business and sustainable business such that it is going to crush the competitors and its products become #1 products? If you have the confidence, go and invest. If you don't have the confidence, never invest in those companies. There are some vague ways, or I would say some very simple ways to identify companies to avoid. And again, some people agree with that, some people doesn't agree with that. That's fine. Different people will have different views about investing in companies. For me, I never want to invest in penny stocks. No matter what the stock is, no matter what the company or its business is, no matter how big the brand is. If it is, say for example, just for the sake of an example, if it is less than 20 rupees price, I will never invest in this company. Because the float is high, there could be so many operators who are active in that stock. Non what is called market information. I have to dig deeper to find those kind of things out. So I never will get a confidence. So if I study the company, if I don't have the confidence, I will not invest. Penny stocks, straight away, no. I stay away from them, no matter how big the brand name is also sometimes. It is speculative basically, most of the cases, right? We'll take a couple of more questions and then probably we can call it a day. Right? There's one question from the chat box again. Can you name some sectors to must invest in this category? Can you suggest some sectors to avoid for some reasons? It's a very big subject, sir. In fact, as I was telling you, in my own webinars that I do, I take a day altogether to speak about sectors. We have a dedicated program. Even on smart investment, we'll do that program sometime later about sectorial analysis. My view is that automobile, one company from automobile should be there in your portfolio. One company from banking and financial services should be in your portfolio. One company from pharmaceutical or healthcare should be in your portfolio, and the others are your second level. So for example, you speak about chemicals, for example. You speak about listed stockbroking companies, for example. These are like secondary, right? For long term, these 4 or 5 sectors are my best. As far as sectors that I should avoid, it depends on the risk profile of the investor. I stay away from infrastructure. I selectively enter, rather, I would say. I don't say a blanket no, but I selectively go into infrastructure. Very few companies qualify our filters. You have to prepare your list of filters. FMCG is a defensive sector. I'll definitely keep a part of it in my core portfolio, my long-term portfolio. I avoid aviation. Any aviation stock, no matter how great the story is, I stay away from them because the business nature globally is not that great. How can my company buck the trend and then become a wealth maker? For me, I'm looking at 10 years, not 10 days or 10 hours kind of investing horizon, right? So that is what it is. Divyaji, you can take a copy of Smart Investment from the website. Go to smartinvestment.in. You will be getting the details about how to subscribe to the newspaper. And let me tell you, it is an investment worth it. You are not investing in something. See, the cost of the newspapers or the magazine is a very small amount. It's not even the cost of a brokerage for some people, right? And what do you get in return? You get lots of interesting insights, lots of interest. It's not just me, but there are so many authors who write every month. And more the editor, starting from the editor to the last person in the Smart Investment team, they have years of experience. So either you read 1,000 books or you read one copy of Smart Investment. That's the difference, right? It's all about time. You get a lot of different perspectives also. So subscribing to the newspaper is definitely a very worthy investment. Not just Smart Investment, but if it is possible, definitely buy some books in the market also, from the market. Read as much as possible. The more you read, the more knowledge you get about all these things. You need to understand, we are investing today where our plants and trees come after 10 years. Right? So be mentally prepared that you should be in the market for the next 10 years. So it's not a hurry. It's not like in 1 hour I have to learn all these things and tomorrow I have to start investing. Right? It's not like that. You have to sustain. Your capital has to sustain. Right? And this is a long game. We'll do that. We'll definitely with Smart Investment, you should be able to do that. Right? One last question. Someone says he's waiting for a long time. I'm really sorry. So many friends are actually waiting today. There is this person, Munaf Patelji. Is he in the? Can he unmute himself and then maybe ask a question, or maybe his question is not attended? Okay, I'll unmute Munafji. Please go ahead, sir, with your question.
Hello, good afternoon, sir. It's
Very good
wonderful session, sir, that you have demonstrated all fundamentals details. Sir, I have a lot of questions, but among that, I would like to ask 3 questions. First of all, I would like to know, when the company has a PE 0, what does it mean, sir?
PE is a ratio. It's a financial ratio. Price divided by equity.
Yes. When it is 0,
the price is 0 or the equity is 0. Right? The EPS. I mean, so the company is basically not making much of money. Ultimately, it is not generating any cash flows. So it's like a dead company kind of. Right? So we want PE to be low, but it should not be 0 or negative, right? Low PE is good. When you compare it with the industry PE, so find out the company's PE, find out the industry's PE. Being a leader, this company, for example, I'll just give an example. It's not a live data point, but you have to check again and then decide. You take, for example, TCS. TCS belongs to IT software services business. What is the PE of TCS? What is the PE of the IT sector altogether? TCS, I know, is a leader in IT services. So a leading stock whose PE is less than the industry PE speaks that it has an opportunity. If it is 0 or negative, not good at all. Stay away right away. If it is more than the industry PE, that means it is having expensive valuations. Expensive. It is expensive. Why is it expensive? That means our investors are buying and holding the stock. Or maybe the price went up because they are anticipating something great in future, and they're absorbing that information. So look for companies with a low PE compared to industry PE, but that when I say low, it should not be 0 or negative. So that's the point I want to make. I hope I answered your question, sir.
Sir, yes, sir. Sir, my second question. Sir, as you know that when the company comes in the primary market, during that period, we are directly purchasing the shares from the company. Okay. Afterward, when we are buying the shares from secondary market, in that case, somebody has sold that share, so I have bought it. In that case, my money goes to the person who has sold that share. It does not go directly to the company. Even in that case, the company is entitled me with all the benefits like right issue, buyback, dividend. Why, sir?
See, when you bought from the secondary market, it means that someone sold. The person who sold would have already bought the share. He bought it from the management, from the promoters, right? From the employees of the company or something like that. So his money, ultimately, even when I'm buying today, I bought from someone else. Even when I'm buying today, some part of the money, some part of the capital is still going to the company indirectly, in the sense that it is from the origin. The shares are issued, the shares are created, they are allotted, right? And then some person has bought, putting his own money, he is compensated. When I buy from him, he is compensated with my money. So ultimately, buying a share means that buying a right in the company. So if you bought a share from someone else, it means that that other person has lost the right. He left the right. He relinquished the right. And you, since you bought the stock, you got the right now. So you will be able to get the complete benefits of whatever corporate actions that the company wants to give you, right? So that is fair. That is how it has to be. Why did you buy the share? Because you want to enjoy the corporate benefits also. Your shares are ordinary shares. Your shares are full-fledged complete shares, right? So you are entitled ultimately to the benefits. It is not the other person who sold the beneficiary of those corporate events, right? It's common sense, right?
Okay. Yes, sir. Now, last question, but not the least. Sir, my last question is that when we go for the BSC side, they have classified some of the stocks like X grade, B grade. So whether this classification plays a significant role while selecting the stocks, because I generally avoid like X grade type of script, even though many magazines like Dalal Street and many of the companies, they recommend such script also, sir.
The grading of the stocks is done by the stock exchanges. It's not specific to a newspaper or a magazine. Let us not name anyone. We'll take it as a normal example. So the stock exchanges have given grading of the stocks. They have put them into various A grade stock, B grade stock, etc., based on some mathematical logics. It's not like arbitrarily some companies have been put into place. The job of the regulator is to protect the investors, right? Investors may or may not know everything about the company. To whatever extent that they can protect, they will do these kind of enforcements. They'll ensure that investor safety is more important. So if you are a low risk taker, if you are a conservative investor, stay away from risky stocks. You have to create your own set of rules. No one is going to teach you or tell you or dictate you. As a market regulator, the SEBI and the stock exchanges, they do their best to protect the investors. So they said this is an X grade stock. Now you decide whether it is a good quality stock or not. If you are a high risk taker, maybe you will take. If you're a low risk taker, you don't even consider that stock. So that's the kind of protection that the intermediaries or the people in the market tries to give you. So basically, yes, it is an important factor. As far as recommendations are concerned, we cannot say as such. See, the recommendations are given generally speaking. It's not targeted to one specific class of investors. They tell you this is good, this is bad of the company. The ultimate decision to invest or not invest is with the investor. So you have, as an investor, each of us, we have to decide whether it's a good company, whether I have the risk to deal with that kind of company or not, and appropriately take a decision. So ultimate decision making is with the investor. We cannot blame or say someone is reason for whatever happened to me, right? Our due diligence, our ultimate decision making is important for us. So answering your question, yes, the grading system is really an important parameter in determining the quality of a stock.
So can I ask one question more?
Yeah, final one question. We'll end the session around 1 o'clock today, right?
Yeah. So there are many companies, they put their CSR report available on their website. But what about the company which doesn't have the CSR report? So that we can able to know about the company background management, sir.
The need for CSR activities depend. There are some rules for the company. Not all companies have to do CSR activity as a statutory requirement. If the company does voluntarily, it's a different story. But as per the Companies Act requirements, not many companies, there are some set of rules that say this companies should have to inevitably compulsorily do that, while it is optional for others. My understanding is that at least starting from last year or a couple of years ago, the activities of CSR, not just CSR, but the social responsibility activities of companies have increased, particularly listed companies. Yes. This is because these companies are not just local companies. They're not just doing business in a small region or just for India. Most companies are international. Their customers or clients are outside India also. continents and countries in the Europe, they are very sensitive to these kind of things. So my view is that every company, more or less every company, has to inevitably come with a green paint of it. So they have to show that they are doing some green positive things for the society. Call it CSR, call it ESG, or whatever it is. Ultimately, sustainability, social dimension of it is definitely an important factor. So if your company is, if you feel that your company should do some CSR activity and yet it is not disclosing the information, write to the company secretary of the company. You can go to bsindia.com, search for the company. On the left side, you have the contact details about the company secretary. Company secretaries, you give your Demat account number, you say you are shareholder of the company. You can just send an email to them, right? And the company secretary does respond to the queries of investors, provided you identify that you are an investor of that particular company. And yes, I believe, and most companies are realizing the importance of CSR and then showing it also on their websites also, not just on the website, even the annual report also, they are now dedicatedly available. If not already done, maybe going forward, we will see that it's a new wave that is coming in. In fact, I have only maybe 4 or 5 slides related to CSR, but not just CSR, I mean to say ESG. I speak from ESG's perspective mostly, because CSR is a part of ESG, and ESG is the word that globally every country is following. But it is definitely going to be a point which requires much elaborate discussion and study. From an investor perspective also, we have some websites from where we can collect these ESG activities data and then rank the companies. In fact, in my 45-point checklist, this ESG is one factor that I consider for long-term investing. Right. So what you have pointed out is really important. And answering your question, company secretaries are the best persons who can give you official information about the company, about this activity, if it is not shown in the website. Right.
Very kind of you, sir. Excellent, sir.
Pleasure, sir. Okay, one final question and then we'll probably wrap up. Right. This question is from Ravindra Jadhav. Right. He says, is any big sector evolving like auto, pharma, IT, FMCG? Because after COVID, seems that a lot of things have changed. A very good question, Ravindra ji. After COVID, almost every company has changed its way of doing business. They're actually forced to do that. Right. IT companies sometimes ago, I worked for a couple of IT companies about a couple of decades ago. So when I was working, we used to have these door passes, right? You have a card, so you put the card, the door, only then it opens, right? So when I was working with this company, there are some doors which I cannot enter, which means that the client business, the client programming activity that happens in that room, I'm not authorized to enter into that. So such were the levels of security. I can't even enter into the room, forget about what programs they are writing and what things they are doing inside. So that was the kind of security, physical security at that point of time. Now, the same IT sector is giving work from home activities, right? All companies are doing work from home. So there is definitely lots of changes that have happened. Which new sectors have come in? Yes, there are, this post-COVID change in business models, some sectors evolving, some sectors going off. This is again a one-time event. After 10 years or after 20 years, if you go back and see, COVID is a small thing. People will be surprised and laughing at us saying that 1 year the whole country is in lockdown, right? So all the companies for that matter have evolved. So I don't give a special sector saying that this sector is the beneficiary, this sector is a victim. For example, hotel industry is a victim, but that is temporary. Aviation is a victim. Even today, people are worried to fly in flights or whatever it is. So these things, the normalcy will come up and inevitably it will be taken over. So if you are thinking about investing to take advantage of this kind of situation, unfortunately, it is again a news-driven kind of approach. It is more of a short-term opportunity rather than long-term. So focus on, now that you have raised the question on COVID, introspect again. Find out how your companies have changed because of COVID, right? Do you think that your company made sustainable steps? For example, some companies might not have done anything different. They're like usual, normal only. If that be the case, stay away from those companies. So find out competitors. Is the competitor looking at sustainable approaches of doing things. If tomorrow COVID comes again, if this Omicron comes again, if there is a lockdown, how prepared are our companies to continue the business? If you feel that is there, stay with those kind of companies. So I don't say that one sector got benefit, one sector got not benefited, but rather take advantage of those companies which you are already holding, because they are more prepared for another wave of COVID if it comes. Any kind of challenge that comes in future, those companies are the best. So instead of, see, my experience says that instead of searching somewhere for a glorious, big, great idea, introspect yourself. The best companies of the future might be already in your portfolio. That you will get to know if you study them in your portfolio. Unfortunately, most of them, we read something and then we jump in and invest, but we don't study the company thoroughly. If you are a long-term investor, you should know everything about the company. So spend your efforts, lots of time, effort, energy in getting more and more about the company, right? So with this note, I end the presentation. Right, over to our friend so that he can give some concluding remarks. Thank you so much for your participation.
Yes, it was an amazing session. Just if you allow, I would like to add a few points to your explanation, of course. As you already said that the sectors like EV and hydrogen fuel, means if someone wants to invest related to those sectors, then they must get some companies which have deep down roots in something, as you already said, Tata Motors. So there are many more companies which are already deep rooted in some business, and now they are moving towards other companies, means this type of sustainability programs. Not naming much about those companies, but for an example, we can take L&T, which is, we all know, a very big portfolio. And yes, they are also moving towards hydrogen electrolyzers and much more. Many more companies are also there, regarding which the article is already available on our website under news tab. Over there, green stocks is the name for that article, and recently one more article is also published on electric vehicle sector stocks. Who are willing to get some knowledge, it's completely regarding knowledge. There are no recommendation, no CMP, no target price, just analysis and sharing type of article. So many can go over there and have a look on it. And yes, they all can relate to your words, as the article is almost based on what you said. So it will be good if they catch on that. And yes, another thing, that long-term investment truly gives a very good return in long term. So along with doing trading in intraday or short-term, mid-term, one must at least invest some amount for long term. So that's what I have learned from your session and many more sessions previously. So now, as we are wrapping up, thank you all for your great presence, and we will look forward to have you all in workshop very soon. We will be conducting, which will be taken by Vijaya Kittu himself. The topic will be shared on our social media platform as well as our newspaper and newsletters. So stay connected, and as we always say, learn more to earn more, which was truly hence proved by Vijaya Kittu today. So bye bye everybody, and have a good day ahead.
Thank you. Have a great weekend, all of you. Have a nice time.